Welcome to this video about decision trees. And decision trees, in the way that I'll be talking about here, is the simplified version. You can go really crazy in doing decision trees, and it's really fun and it's really relevant. But let's dig into it. Why are we talking about this? I have a lot of text here behind me. What you usually have is what's called discounted cash flows. Discounted cash flows takes the number of cash that flows back to you over time and thereby estimating, evaluating whether an investment is good or not. However, this kind of traditional discounted cash flow has a tendency of underestimating the value of an investment, especially if it has what's called options embedded. Options embedded might sound a little bit finance, it's not. In essence, it just means that you can delay your investment. So you can say, things are not looking so well. We will not do the investment right now. What you often do in real life anyway. Or you can change things. We can adapt it. We can push it forward. We can change prices. We have some flexibility in how big our investment or how big our initiative is. We can expand it. We can say, this is going great. We will build another warehouse. We will put in another line in our production, or we will add more people to our sales force. We can expand it, or we can see, this didn't go as we expected. We can stop it before we invest all the money, before we lose all the money. So we have these options, we have these possibilities inside our decision sphere. So these real options or decision tree theory advocates that we should be able to pay a premium on these discounted cash flow in our value estimation because we can get better. Let me take an example. We have a bad investment here next to me. If we have success, we will earn $100. If we fail, we will lose 120. It's 50-50. We don't really know which way it's going to go, but we estimate it's a coin toss where there is. Below, I've done the small calculation so you can see half or 50% times 100 plus half time is negative 120 is a result of minus 10, meaning in a traditional sense, we should not do this investment. However, there might be some options embedded in it. We can do something and we can make it a good investment. We can invest a little bit. It may be a pre-study. We invest $20. We figure out, well, based on that, there's a one-third probability of success, 2/3 for failure, meaning that if we at that point loses, we will or figure out it's a failure, it's not something that we should do. We abandoned it and we've lost the $20 that we've invested. However, it's also possibly a success. So we will earn 20. Based on that, we will do an additional investment. Think of it in the way that you're going into a new market. You do a small test marketing, and if it goes well, the probability of success then is higher. So we have a success probability of 2/3, and then we will earn 20 more. It's exactly the same as in the previous scenario. If we fail, we will lose the 100 still, plus the 20 more we've already spent. By doing this, we move our investment scenario from a minus 10 to plus 13, as I've shown down here in the calculation. it has become a good investment. That's the basic premise of our real options. Can we change our investment or abandonment portfolio strategies and therefore get some different options? We can get a more clear view on what we should and should not do. When we do these decision trees, there are a number of elements. Here's what's called the uncertainty nodes, shown as gray circles, decision nodes, blue squares. We add some probabilities for each of them. We have some discounted cash flows going back, and then we have some time. You can change these figures out as you like, but the basic idea is that we list things up and we see there's something that we're uncertain about, and there's some decisions that we need to take along the way. This is an example where it's shown in more complex form. The first level where we have our uncertainty nodes at the end, that's our classic discounted cash flows without any options. But when we then add on our decision nodes, we do these kind of things, we don't know how it will go, uncertainty about it, and then we put an option or a decision node at the end of it, we can move forward. So if we are in a delayed test marketing scenario, we don't know if that's going to be good or bad, but at the end of it, we will have to make a decision. If there is a positive response, we can invest, or we can still delay. If there's a lukewarm response and people say, maybe this is something I like later on, we can delay, but we could also choose to invest. And the probabilities of success will change at each of these levels. This way, we can put up a number of decisions moving forward in time that would give us a better standing point when we need to make the decisions. We can also build our trees out and see, okay, it might not be that this is the best investment right now, but it opens up our options moving forward, and therefore we can get business out of it, and therefore it's a good investment decision. The insights that we're looking at here is that we have a language, we have a tool which can frame our decision making. Decision making is not a black or white scenario. It's not a do or do not. It also includes our, well, do a little bit now, do more later, or do a lot now, do a little bit later, delay, do everything later, and those kind of things. What we also have is that we should not be fixated on a most likely scenario, because the options that moves on afterwards will also give us some possibilities. If we have a project which has a net profit less than zero, meaning that our investment now is bigger than what we expect to get back, but we should not dismiss it just then, because it might open up some possibilities which we can earn on later. In the same way, if we have a possibility of doing something now and we on the short term would earn money on it, well, maybe we shouldn't do it if it doesn't give us some options on maneuver room later on. We should build options into our core business model. It also gives us the idea that we should invest in stages. We will become smarter over time, or at least I hope so. We will know more. So when knowing more, we will also have more certainty about the decision. So if we can split our investments in multiple stages, we can get more information and be more certain on doing the right decisions. Lastly, we should pursue several tasks at once so we can do more and expect some of them to fail. It's okay. And Therefore, our volatility can enhance value. So if things are changing, it is a business opportunity. How we work with it is that we focus on the most important decisions. We cannot put every single decision into a decision tree, but we should have the most important one. We start from now and we reason our way forward in the decision tree to construct it. We track certainties and uncertainties at the decision points. Where are we now? What are we certain about? What are we uncertain about? And then we calculate backwards to evaluate the choices. And therefore, we can select the tree branch which has the highest expected value. Should we invest a bit? Should we invest a lot? Should we wait? However, decision brand that gives us the biggest return is the one that we should move forward with. I have a bunch of examples here on the side of real options or examples of decisions. The defer, expand, contract, the abandon, staging of the investment, switching input output, and grow. You can look to them in details yourself, but I just wanted to take a couple of examples. We stand to contract something out, expand it. Sometimes we can add a subcontractor. Think about the flexibility that we want to build into our business. Having contractors, having partners will enable us to do that at a later stage. The same way if we switch inputs and outputs. These days, there's a lot of talk about disruption of the supply chains. Just yesterday, there was talk about the cardboard industry not being able to deliver. Those kind of switching of inputs is something that we would like to build into our business. Can we switch from a cardboard box to a wooden box to a plastic bag? Have we thought about that up front? Have we been able to predict, well, we're most likely in this branch of our decision tree? We should be able to build our business at a strong foundation, almost no matter which decision we have to do, which direction the world is going. That was it for the introduction to decision trees. I hope you enjoyed it. See you in another video.